Good afternoon, everyone, and a warm welcome. It's great to see a close to full house here today and a large number of us joining online. My name is Amanda Castricum, partner at Favoured, and I will be your MC for today's event. Before we get started, I would like to respectfully acknowledge the traditional custodian on the land on which we gather and virtually meet today, and pay our respects to elders past and present. We extend that respect to all Aboriginal and Torres Strait Islander peoples and recognise their rich cultures and continuing connection to land, waters and airways. Today we are joined by an esteemed panel of M&A experts who will take us through the key trends and insights with a focus on mid-market. It's a pleasure to introduce our moderator, Brad Purvis. Brad is a partner at Favoured and our national lead of our financial advisory division. From a banking perspective, we have Victoria Wright, Portfolio Manager, Commercial Banking at Westpac Bank. Discussing legal considerations, we welcome Justin Fox, Partner and Head of Corporate at Hamilton Locke. From a private equity focus, we welcome Will Whittle, Investment Director at Navis Capital. And finally, Specialist Advisor at Favoured, Simon Johnson. Before I hand over to Brad, some brief housekeeping. At the end of the session, we will endeavour to get to as many questions as possible. For those joining us online, we encourage you to submit your questions throughout the event. To do this, if you hover over your mouse over the screen, in the bottom right-hand corner, you'll see 3 dots. By clicking here, you can submit a question. For those in the room, we will ask that you hold your questions until the end. We'll see how we go for time in relation to responding these. However, if we're not able to answer these at the end of the session, please join us for drinks and nibbles, where we will have an opportunity to chat with our panellists. We request that all mobile phones should now be switched to silent, please. Bathrooms, if you need them, are located back out to the lifts to the right. And in the hopefully unlikely event that technical issues arise and connection is lost, you'll be able to access the recording and from the same link afterwards. So without further ado, I would like to hand you over to our moderator, Brad Purvis.
Thank you, Amanda, and again, welcome everybody, those people that are in the room and those people that are joining us online. Quite excited about today's presentation and conversation and discussion. A number of questions that we'll be posing to the panel, very much around, as Amanda said, a focus on the mid-market and particularly privately owned businesses, which I know are very close to a number of us in the room and those joining us online. So I'm very keen to get things moving. So we do have a full list of questions and I want to kick things off and get the panel involved. So my first question to the panel is, in terms of merger and acquisition activity within the Australian mid-market, what trends are we starting to see in 2024 that perhaps are different to what we saw and unfolded in 2023? So Will, I might even hand that one over to you to kick us off.
Yeah, sure. So the last couple of years has been a funny one. We've seen a low level of transactions because we've still been coming out of the after effects of COVID, high interest rates, inflation. But now as we look forward, we're starting to see some of those macroeconomic factors resolve and confidence is coming back into the market. So certainly from our perspective, our pipeline is filling up and we're starting to see a lot more opportunities in the second half of the year than we have over the last couple of years.
Victoria, any particular view through the banker's lens?
Similar, it's definitely been picking up and building up compared to last year. And I think along the lines of what Will was saying, customers have been through, I suppose, a lot of economic uncertainty. We've now got what we think is the full impact of interest rate rises, so customers know what their new cost base is, so potentially things that they've been thinking about doing, they now feel like they can go out and look to acquire or sell if that's the case. So things are starting to settle a little bit.
And we might circle back on that interest rate theme in the context of deals and transactions, so hold that thought. Justin, from a legal lens?
Yeah, similar story for us. We're seeing good volumes of mid-market deals come through the firm. We've seen, I guess, particularly that being driven by growth-focused private equity who are back in the market. I think with interest rates settling a bit, it's giving transaction parties greater confidence in their valuations, which is a good basis to do deals on.
Simon, I know we've seen a little bit of an increase in activity in the last month or two.
We're busy, which is good. I think that the dangerous thing here is that for 2 years the market was certainly depressed, and I call it depressed because nothing was happening. There wasn't buy or sell. It was what do we do? When do we do it?
Yep.
The concerning thing is that deals are already taking longer during that time, and I think indigestion's about to occur because there's going to be a plethora of deals on the market. There's only so many advisors and banks and financiers to see them, and we're going to have to work through those and decide what's good and what's not. I'm interested to learn for the next hour what everyone thinks about this, but I think vendors are being a little bit more sensible about what their business may or may not be worth and the deal terms to get a deal done. But we might explore that a bit later on.
And we might also talk about what I know we're seeing with owner-managed or privately owned businesses, with people getting to a point in perhaps that business life cycle where there might or might not be the next generation wanting to come along, there might not be the management buyout, and there's a bit of a crossroad.
Yeah, I don't know if anyone in this room has heard of it, but there's supposed to be a tsunami of baby boomers exiting the market and selling their business. Well, it's been 10 years I've heard that and it still hasn't happened. So maybe it's coming, but I think succession planning was, is and always will be top of mind. Families don't always divest businesses to family members, and private capital needs to come in and they need a team of advisors and a bank to, I guess, hold their hand through that process.
Excellent. Might move on to question 2 because there's some flavour in that sort of first question that takes us to this point. Transaction trends. So, what are we seeing today? I know we'd seen some delays in due diligence process in the past, particularly last year, whether that was people sort of on purpose holding and slowing down deals. And then, timing around deal closure. We were talking about earn-outs before. What does all that mean to our clients and other people that are wanting to buy or sell? Victoria, do you have a view on that? Or Justin, do you want to kick us off on that topic?
Me? There's certainly, to what we were saying before, I suppose around a lot more research and due diligence going in from the buyers, and then likewise some preparation from the sellers. So it's not making deals happen any faster. And as Simon was just saying, we're very busy at the moment and seeing a lot of it. But as far as trends, there's plenty of good transactions out there, and we can probably get into sectors and things like that.
We'll
do that in a minute.
Yep.
But yeah, I think that a higher level of sophistication and advice is going into some of the deals as well. And from a bank's perspective as well, from an appetite perspective, we certainly like to see a good level of due diligence, and the deal has to make sense.
From a PE perspective, I know we were talking before about, there's new funds that you're establishing.
Yep.
You got a new one,
This
don't you?
End of the year.
How big?
I'll tell you later.
And I think there's pressure on sort of close dates and
Yeah.
so maybe take us through what you're seeing from issues in deals.
Yeah, so we're really seeing two big thematics around the way transactions are run at the moment. So because we're really only just seeing buyers and sellers start to come back together after this couple of years of disruption. So people are still a little bit apart, but we're looking for ways to bridge that. And so the implications of that are, one, deals are definitely taking longer. So as buyers in many situations, we want to do perhaps even more work or get even more clarity and certainty on issues that we're looking at than we did previously. And that's extending due diligence processes and certainly putting more pressure on sellers to really do a lot of work and a lot of preparation. And then the second thing we're seeing is a change in deal structures. So a lot more earn-outs. We're trying to push more risk onto vendors, and just being candid, we are trying to find ways to push some of those risks onto vendors so that we can get a deal done at all, because the alternative might be that we just can't find a price that makes sense for both of us. And I mean, I'm happy to say that in those discussions that we have, it's actually pretty well received. We're trying to constructively work together towards a deal versus maybe a year ago or 2 years ago, we were just maybe too far apart.
What do you see though from a legal perspective?
No, I totally agree with that. We're seeing more nuanced and bespoke transaction structures, so earn-outs, a lot more sort of joint venture type deals. So rather than 100% takeouts, some sort of shared equity going forward. Also in terms of funding, we're seeing more convertible debt being put in there or preference equity, those sort of things. I think what that's about is, you're right, Will, it's about transaction parties groping around trying to find out how to deal with some risk which is baked into the system. So if you think about it, COVID's not that far in the rear vision mirror. There's some geopolitical forces creating risk We've got obviously elections coming up in the States, a new government in the UK, election here. So it's really about transaction parties saying, how do we share that risk going forward? So we're seeing, a lot more time being put into thinking through those issues and working out how structuring might end up with shared risk.
Do we think share or take it?
We take opportunities and we share risk typically. But they're two sides of the one coin, and I think this is the point. There's no bespoke answer in the mid-market anymore. Right. So, if I look back, 5 years ago, clients would come to us and say, I'm getting out, I'm selling to this person, it's a 100% deal, we do a share sale, we negotiate warranties and we move on. Yeah. It requires a lot more thinking now to find the right answer for your asset.
You bring up something really important actually about warranties, and there'll be clients in this room or businesses in this room that, warranty and indemnity, for example, there's now an entire insurance product around that part of the market. And you say 5 years ago, let's go 5-10 years ago, you'd have a lockbox data room. The vendor would say to the buyer, there's all my information, there's my business history, go your hardest, and then I'll sell it all to you lock, stock and barrel, and that's it. There is no earn out, there is no warranty and indemnity regime which gives them cause. It's, no, you did your due diligence, do you want to buy it or not? Fair to say those days are out, gone, not coming back.
Yeah, I think that's right. I mean, buyers are looking for comfort, and giving warranties is part of it.
And hold that thought for a sec, because I want to cover that when we look at how we can help founders of businesses, sell with more confidence, and it sort of comes back to that theme. So I want to just keep rolling because I want to spend some time on that. So, to your point before, Victoria, can we think about mid-market sectors that are currently a little bit more appealing? Perhaps those that are hot, those that are not so hot. Why? And then how can we use that to try and help our clients that are buying or selling strategically using that intel? So maybe Will again. I mean, you're buying and selling businesses all the time.
Yep.
What's hot? What's not?
Yeah. So we're seeing a lot of activity at the moment in professional services. We were talking about this before. One of the things that's great about professional services businesses is there isn't much of a cost to grow. You don't have to spend money on CapEx. And that's quite attractive in this interest rate environment where everyone is very hungry for cash. And then some of the other sectors that we've spent the last couple of years spending a lot of time looking at, healthcare, education, they're definitely still interesting sectors for private equity, but just very carefully making sure that they still have the sustainability of earnings over the last couple of years, because lots of businesses have struggled.
If we've got time, we'll talk a little bit about AI later on, whatever that means.
Accounting industry, Brad.
Thank you. I've been wanting that answer. I've been waiting for that for so long. Thanks. Justin, did you want to comment about renewables, energy? Did you have a?
Yeah, well, we're finding in our practice that anything that touches carbon energy transition is hot. So obviously technologies that help energy transition and things that hang off it, like carbon trading, those sort of assets will attract interest.
What about the bank's perspective? What's on the nose? What's not good?
I was going to say, if you asked me 12 months ago, I probably would have said transport and logistics, we're seeing a lot of activity there, and now we're just seeing a lot more stressed accounts, which it probably won't be a surprise to anyone. They're obviously well connected to the issues we're seeing in retail trade and wholesale trades. That sort of makes sense. So that's probably not as hot at the minute. Not to say that there isn't good businesses out there, because there still is. But on the prof services side of things, I mean, that's been really active. This is all publicly available, but groups like Count Plus, Kelly's, Prime, the bigger conglomerates. You were talking about baby boomers before. Certainly in the prof services industry, there's the older generation that have built up their business. A lot of sole practitioners still out there looking to sell, and they're getting good money for these businesses. So, in a roundabout for the small, like the smaller end, so sole practitioners, small partnerships, when you sell, they're getting dollar for dollar on revenue, maybe a bad book 80 cents, a better book $1.20. And then when you get to the sort of bigger revenues that are, say, north of 5, 6, 7 mil, multiples of EBITDA, say for accounting, you're looking at maybe 5 or 6 times, and fin planning even better, sometimes up to 10 times, because as you're saying, like, people are after that sort of continuity of cash flow. It's very sticky, it's good revenue, and you can just keep bolting them on and it tends to make more money. So that's definitely a hot industry.
And on that point, I know I've got some clients in the room and online who are interested maybe to get an observation on software as a service. I wasn't sure, Will, whether that was something that you might want to comment on?
Yeah, so we actually have a SaaS business, or actually a aggregator of SaaS businesses in our portfolio at the moment. And the things that we like about it, sticky, high cash flow conversion, all of these things are attractive to private equity. The struggle for us is that valuations have run pretty hard in software businesses, and so it's about can we find the right businesses at the right price, and then take them through that step from being small software businesses into something that's more enterprise level, enterprise grade, and then find the next home for that business. That's really what private equity is all about. Taking businesses through to the next horizon.
I'm not sure if we've got time, but I'm going to throw this one in. Manufacturing. I think we were talking a bit at one point about there's a little bit more support coming in for the manufacturing sector.
Yeah, I think generally, and from a bank's perspective, appetite's pretty good. I mean, it is for any good business, but those that are in sort of key service industries and supply that have a good ongoing revenue and cash flow, like you would expect. I mean, there's certain ones that are connected to areas that are not so good, but manufacturing is still pretty strong. And we've still, despite what people say, we've still got some good manufacturing in Australia.
Yeah.
So,
I actually think I'll second that. So our monthly deal book of opportunities from people like Will or funds or private capital is now got more industrial focus than it does software as a service or tech. It's now
same for us.
We've come out of COVID. There's supply chain shocks. There's logistical shocks. There's raw material exchange rate shocks. Trump's over in America saying, "Build it in America," and Australia and the Aussie Made campaign keeps getting more and more tailwind, and manufacturing's hot.
especially as I was going to say, we see a bit from overseas companies wanting to buy Australian manufacturing because it is good and it's desirable.
Yeah, I think we've seen. I was actually out just meeting a family-owned business earlier today, and they manufacture a lot of product in Australia. And I think we're seeing some of the consumers of these different types of manufactured products think, maybe it's better for me just to pay a little bit more for something which is local. And they want something which is local, not necessarily because they're supporters of Team Australia, but because they know that they're going to get service. They know that the parts or whatever's required to repair it is on site, and they know the lead times are shorter. So people are being a bit more, they're thinking beyond just the price.
Excellent. I want to spend a bit of time on the next question. I know we were chatting about this before. It's a bit of a three-part question, and I think it resonates with so many people, again, in the room, but particularly clients of our firm and probably of your practices and businesses. So 3 parts. Sort of part 1 is how can we help founders of businesses, to fully or partly divest? And then what tips can we provide to those business owners to help them navigate either that acquisition or sale path? So it's a bit of a sort of a 2-in-1. And then finally, if someone's looking to sell and divest, how can we assist them to sell with confidence? So I know there'll be a few things. It probably goes back to some of those topics we just touched on before. And maybe warranties, nervousness around warranties. What does that really mean? Mm-hmm. And how can we make sure those warranties are really going to be proved up? Maybe that's one thing to throw your way.
Yeah, sure. So I mean, we like to tell our clients who are thinking of selling business that every dollar you spend in preparing, getting yourself sale fit, pays you back in a multiple. So do the work to get your business in the right shape to take to market. And for the lawyers, that seems like do you really understand your cap table? Are assets in the right spot? Have you got contracts in place with your key executives so we can help getting all that stuff ready? In terms of warranties, I mean, you're right. Vendors will expect, buyers will expect a vendor to stand behind their business in terms of warranties. And we do, find a lot of founders get nervous around that. And, I challenge that nervousness and that anxiety, because if you've done the work and you're a founder and you've worked in the business, every day, no one's got better understanding of that business and where its risks are than you do. So you ought to be the person who's prepared to take on that warranty risk. The lawyers can find ways to spread it around. If you are nervous, there's warranty insurance. We can, get the best warranty package we can for you, but they all cost you money at the end of the day. Either by paying a premium on a warranty insurance, or it'll just be baked into the purchase price you get. So we like to encourage our clients to do the work early so they can take their asset to market with confidence.
Will, off the back of that, founders staying in the business, what does that look like when you're buying a business?
Yeah, so we love it when founders stay in. Our business model is very much about partnering with people. It would be extremely rare for us to buy 100% or even more than 70% of a business. And the reason why is twofold. One, it's a great signal. When a founder wants to stay in, it shows that they're confident in the business. And then the second is that private equity, we're there as partners. We're not there as sole operators of businesses. So we want to work together with someone else. So one tip that I'll give you is sometimes when we're looking at businesses being sold by founders or families, they'll say, I want to sell, maybe 100% of the business, or maybe I'll retain a bit of a stake. And in our mind, sometimes we hear that they're willing to sell 100% of the business. That's not a positive sign. So again, with some good advice, you can tailor that message to be a little bit more, to show greater confidence in your own business. If you say, I only want to sell 50%, and then maybe let the private equity fund talk you up to 70% over time. That's a much better message.
Let's write that down, Brad.
I am. I'm scribbling that at 100 miles an hour. I can't write it down fast enough.
You said something interesting. Maybe I want to. When you hear maybe I want to, that sounds very uncertain, and to me lukewarm, and to me as a private equity investor, I'm thinking, well, is that their business, lukewarm? Are they not sure? Are they flip-flopping all over the place? It doesn't sound very definitive. It doesn't sound very confidence-inspiring.
Yeah, I want
to know.
I think there's a broader point around this, which is be very sure about what you want before you go into a sale process.
Yeah.
Right. A stitch in time saves nine. All of these different ways of expressing it, but preparation is key. Do the work. Don't go and speak to buyers until you know exactly what you want and you've got everything nailed down. Because ultimately, if you come into a sale process with all of the bits and pieces that you need prepared, that enables you to run more bidders, more high probability bidders against each other, equals more competitive tension, equals a better price and a better outcome for you as the vendor.
And you enjoy that process?
Yeah, I'm sort of speaking against my own book here. Please don't prepare. Come and speak to us directly.
But just on that, Victoria, the bank must hate it when a deal comes up and there's 7 scenarios for the bank to consider. Surely you just want to be given one scenario. This is what we can or can't do.
Yeah, you do. You are a little bit more wary of the ones that it's like, I'm thinking to do this, and and it's a bit out here, and there might be someone here, and it's all maybe this, maybe that. Am I going to stay in? Am I going to stay out? Similar to what we were saying, when we look at any sort of acquisition, even if it's our customer buying something else, we'll still always want to know what's happening with the business coming in, as far as the corporate memory and the expertise that's staying with the business or isn't. So yeah, that's sort of almost making their problem the bank's problem as far as appetite. Like we get asked all the time, I'm not really sure, can you tell us what you'd fund in this? And it's like, well, it could be anything. So same to what Will was saying, like preparation is so key. I've seen some horror stories with customers that have sold without being prepared, without getting good advice, and they've ended up not keeping nearly as much of their money that they would think. And I suppose the only other thing would be think about the advisors that you've got around you. Businesses often have had really close connections with their accountants and lawyers and everything, and they're wonderful, but sometimes they're not the same ones that you need for when you want to buy or sell a business. So, and think about your structuring and all that sort of thing. Again, the customers come before, we've got this offer and we're going to sell, and they've still got personal assets tied into the corporate entities and all sorts of things, and you sort of think, no, you're still like a good couple of years away from really being ready.
And I think you're right, and I mean, I know Simon will talk about this a little bit more in terms of that readiness piece, in terms of getting your business ready. But, all the things that you typically do to get yourself in the best possible position to be able to make that exit or sale are the things that you should ordinarily be doing in your business anyway. Because if you get your business into ship-shape order, and not necessarily in anticipation of selling, well then it's going to be worth real money to you on that journey, and then you're going to be in the right frame of mind and the right condition for when it does come time to sell. And Simon, that other thing about we'll touch on deal fatigue if we get it all wrong, speed.
Yeah, so those are two very key considerations, and the thing that kills every deal, no matter how good it is the fatigue part, where stop, start, and the sequencing is all off. You could have the right combination to the lock, but you're doing it in the wrong order, and it just kills every deal. It could make sense on paper, and often, Justin, you've probably been there, where we all sit in the war room after and we go, how did that deal fall over? It was just set in heaven to happen, and the answer is they got into it too quickly, they weren't ready, they had to stop, and then when you stop, people jump at shadows. Things happen, and all of a sudden everyone's at war, the deal's not going to happen. It's over nothing often. But it's just a matter of being ready and I guess being a little bit of having a pause button, getting your house in order, and then going ahead. Now we are accounting, and I just want to make this point clear. Justin, you tell me if I'm wrong, but how many vendors do we see and we say, well, is it an asset sale or a share sale? And they go, oh, it doesn't matter.
Yep.
I can tell you right now from a tax perspective, it bloody does matter. And also from a warranty regime, it matters. So I think some of those fundamental deal structuring questions should be happening between lawyer and accountant well before we're talking to Will or even the bank.
And take your time to get that piece done.
Absolutely.
And so that could be 12 months, as I said before. Or
Could be 6 months or 3 months, but more than, like, how many times do we get onto a deal and the deal's already in the term sheet and you and I are trying to work out what we're doing?
It happens all the time. And then you're sort of backpedaling to get back to the discussion that should have happened in the first place.
Yeah.
All right, so I think, the three-part question was around, how can we help founders, by partly or fully divesting, navigating the pathway, and then selling with confidence. And I think probably the clear message is preparation. Get yourself ready.
Or just have a
Spend the time.
conversation early. I mean, I'm sure a lot of family businesses are having board meetings quarterly, half annually, biannually, or whatever it might be. And often it's easy to have a business planning or operations meeting, but the question should be asked in every board meeting or family get together around the dining room table, are we ever going to sell this thing? And if we are, who to and what for and how might that look? I think that's where you start.
Well, I can give you an example there. So obviously our business, we're in the business of buying businesses and then selling them, right? And typically that's a 5-year period. We will start thinking about the exit at least 18 months prior. And when I say think about exit, that is going through this whole list of things, getting all the tax structuring right, which advisors are we going to use, write a 5-year growth plan, start drafting up an IM. All of this stuff happens 18 months out because you never know. Someone from another fund or a trade buyer or someone could approach you and say, I've got a deal, like let's do this, and you want to be ready. So yeah, 18 months out for us.
Yeah. And maybe just a final point on this from me. Sometimes the reason you're doing that work too is to know which deals not to take. So, as a founder, you can find that someone arrives with a pot of money and it looks fantastic, and if you don't have a sense of value of your own business at that point, you might take the wrong deal.
Yeah, really good point. Alrighty. Let's move on to the next topic, next question around trends and influences that we might be seeing from an ESG perspective. Now I know from a banking perspective, you're starting to really, the pedals hitting the floor, or however you want to cover that. Do you want to kick off on, what is the bank's view of ESG? The other thing I want to talk about is whether we really see it as a pain point or not, and why perhaps we shouldn't see it as a pain point.
I think there's an expectation now that ESG is part of all the businesses that we speak to, and I mean it's the same for the bank. It used to sort of be somewhere down in the annual reports, and now it's generally covered on the first pages. From a banker perspective, as far as how they manage it, it's addressed at every deal. We've got ESG teams set up now and clear policies. We have to check it in every annual review for our group, so it's certainly front of mind. In saying that, it hasn't been an inhibitor as far as getting deals done. I think we're pretty practical about how we approach it, and customers are getting a lot more sophisticated around it as well, and having those policies in place and practices in place, and how it all fits together with not only their own appetite and governance and how they want to present to the community, but likewise from a bank's perspective, because we're going to be considering that when we look at a deal.
We were talking before about supply chains and trying to understand who's where in the queue. Will, is it something that you've got a view on in terms of ESG from where you're sitting?
Yeah, so for us, ESG, we definitely think about it a lot within our fund, but it is really pushed down by our investors, who ultimately are superannuation funds. And they have very clearly said to us, this is something you need to consider on every single deal. So that's one aspect that forces us to think about it. The other one is it does actually drive better valuation outcomes for a lot of businesses. So I'll give you 2 examples. We own a business called Mainland Poultry, which is New Zealand's largest egg producer. We get a massive premium on selling free range and cage-free eggs, and we've seen an uplift in profit and margin through that strategy. That's a really obvious one. We also own another business called Haynes, which sells infection prevention consumables to hospitals, and their products are slightly more competitive, slightly more expensive than some of the competitor products, but the difference is that they're biodegradable. So you can imagine these things which were previously plastic being used in every single operating theatre. If you can make those biodegradable, it makes a pretty big difference. And so we're finding that that's a very strong competitive edge for us against competing products in the hospital system. So it does drive real value. It's not just about compliance cost.
And so, can I just add one more thing from a banking perspective? If I think of specific examples where potentially, not that the bank's views entirely changed, but it's probably moved in a slightly different direction around social responsibilities, industries like pubs and clubs and drinking hotels, particularly in New South Wales, Queensland, where the model's a little bit different. There's been a shift around the percentage of gaming versus, say, food and bev as far as revenue and policies that have been set around that, and working with the customer to make them a little more even, i.e., we probably don't have as much interest in clubs that sell one beer and do lots of gaming. It needs to be a little bit more balanced around the responsibility side of things.
Justin, you reckon clients are ready for that?
Well, lawyers are in an interesting spot on the whole ESG discussions because what we sell is compliance, but actually compliance is not a test anymore. So we can tell you what the law is and what you need to do to comply with the law. But in this process, and I think I totally agree with you, Will. The new regulator of ESG are the superannuation funds, and they push that down through everything which they invest. So that's the gold standard. So if you want to sell your business to businesses like Will's who come with their own ESG requirements, it's higher than compliance. It may be an international standard, but it's higher than compliance. So you actually need to get beyond where the lawyers can help you and actively take on ESG and have a story to sell.
Yeah, and for some businesses, if you have a choice of different acquirers, there are a set of acquirers for whom these ESG components are really, really important. So, for example, if you want to sell your business to Wesfarmers or Mars, one of these big international conglomerates, they do look to see that you're compliant with things like APCO, for example, which is the standard around using recycled cardboard boxes in your packaging. These things actually drive their interest in your business. So if you can demonstrate that you're compliant with these different ESG standards, it will actually change the valuation outcome for your business when you sell it.
I asked one of our team members, Brad, about value drivers, and I didn't know this, so I had to write it down. But other than the last 2 years, the long-term 10-year average of an ESG sustainability fund is outperforming the market of the top 100 S&P by 36%. So I think...
Put that in plain English for me.
Plain English means that companies that are proactive on ESG to the point that they're using recycled goods, they're looking at carbon footprint, they're probably publishing publicly their gender pay gap, whatever that gap is, there's an actual index for that. They're probably doing that proactively rather than we have to do it all in the next 3 years. They're doing it on the front foot. They're probably looking at over and above extended leave for bereavement leave and compassionate leave. All those things go into a fund, and those companies are earning 36% more returns for shareholders than those that don't do it. And just being a snowboarder, I just want to point out that the most expensive snowboard in the world uses 100% plastic bottles recycled. So just
is it quicker?
I own a couple. And I can't write any of them.
Any other comments on ESG? Or I think that gives us a bit of a perspective. Yeah, good. There was one other topic that we were going to touch on, which I want to bring into the conversation, and that's ACCC changes. Yep. What does that mean for mid-market?
Does everyone know? Maybe you could explain that, actually.
Yeah, so the government has announced we're moving from the current voluntary notification for merger clearance through the ACCC to something which will be mandatory. And it'll be mandatory, and the detail hasn't come through yet, but it'll be mandatory for deals which are a surprisingly low sticker price. So they're talking about $30 million, something you have to notify to the ACCC and go through a formal clearance. Look, what will that do? There's a lot of gnashing of teeth around this, but fundamentally it's the same system they have in the US, they have right through the EU. Modern economies live with this sort of system. No one likes more regulation, but I think it'll be, the practical issues will be twofold. Number one, deal processes will stretch where you need to get ACCC approval. And as a seller, that's not your issue, but you take it into account when you work out who you want to deal with and who you want to sell to. It's more deal risk and more time. So certainly there'll be an extension of timetables. And then I think, the other thing that's really interesting is the ACCC has been very public, saying they want to look at what they call creeping acquisitions. So, if you acquire the same sort of business over time, any one of those acquisitions might not have a competition issue in itself, but when you aggregate them up, you end up with an issue. So I think for, mid-market founder sellers who are selling into roll-up type structures, there's probably more regulatory risk coming through than there was previously.
So childcare would be a good example.
Childcare, aged care,
Yeah.
veterinary plays,
Yeah.
all those sort of things.
Yeah. Where the ACCC is going to be, or a panel member, because my understanding is it won't go to the full tribunal. There'll be a panel member reading a document and then referring it to the panel, and they're going to have to decide what's an appropriate anti-competition down to the suburb in case of a vet or a childcare or
Correct.
practice.
Yeah.
That's scary.
And yeah, hopefully there's no ACCC people in the room that I'm offending by saying this, but
We vetted the list quite well. Oh, that's on video. Can we edit that out?
we can't. The ACCC will give us a timetable for how long they think it'll take them to review these things. Double it. Yeah. So it will have a real impact on the speed and certainty of deals, and definitely in the mid-market with these creeping acquisition laws.
We said if we had time, we'd go back and have a look at a conversation around interest rates, and we probably didn't give enough time to that before. Victoria, do you want to? I know you've
Give
got
a bit of a view.
shared view that you might want to pass on how that might impact, I guess, on clients, buying and selling.
Yeah, so the asterisk with this is I'm not an economist, but I'm happy to share the bank's view. So the current view from Westpac and our chief economist is they're still forecasting a rate cut in November, with 3 to follow in Q1, 2 and 3 next year. And whether there's some raised eyebrows around that, because when you look at the markets, that's not actually factored in as yet. But I suppose sticky inflation doesn't necessarily mean that it's stuck. And it's definitely been coming down since the peaks of a little over 6.5 in 2020. And I think what the economists are looking at now is there's, from the rate cuts, the full impact of that doesn't often come through till sort of 12, 18 months later. And when we look at some of our peers overseas, Bank of Canada, the ECB, a couple of other European banks have already started cutting. Some of them did it before we hit target inflation, and there's some Australian factors around housing and things that are specific to us that you probably need to factor in. But I guess where it's heading is the Reserve Bank, arguably they're a little bit late when it came to cutting rates. They definitely don't want to be late, raising rates. They definitely don't want to be late when it comes to cutting rates, because if we undershoot and we end in a deflationary environment, then we've got a whole set of other problems. So that's sort of the view from the bank at the moment. And yeah, for those of us out there like me with young kids and a reasonable mortgage, I've got my fingers crossed for November, but we'll see how we go. But that's the view at the moment.
Just from a mid-market point of view, I'm a family business, $40 million of value, and I hear that, and I'm thinking sometime in the next 18 months, I'm going to go over to Justin and say, I need to talk to you about getting my business sold. Brad, I want you to structure it. I've got this guy here who just told me if I'm really well prepared, he's going to pay triple the rate. What does that macroeconomic view do to a business owner thinking about selling?
I would think as a business owner that you can have a little bit more capacity around your cash flow, because we've seen the opposite of that obviously in the last 18, 24 months, and lots of strain on cash and covenants and things like that. So you would hope it would bring a little bit of positivity into the view.
Okay.
Yep.
And if you were advising clients of the bank in terms of return on that capital, is the bank really looking to the mid-market companies to be reinvesting in themselves rather than, for example, pulling out dividends? And
Oh, we like to have a bit, and it depends what you're doing. Particularly if you're buying and selling, the banks like for there to be a bit of your own money going in or from somewhere. And we're not against money going out or dividends, but it has to be not in detriment to the business, and it has to be reasonable. But I mean, people are in business to make a living for themselves, so we would only put a hard stop on that sort of thing in a more distressed situation, or if equity is getting really low. But if it's if there's fair and it's all there's a bit going in from us and there's a bit going in from you, and the rest is in the business, then that's usually fine.
Yeah, Brad, how are we going for time? Are we good? I've got a really burning question.
The bell hasn't gone off
I've got
yet.
one burning.
So as long as you don't start singing or anything.
The emergence of preference equity.
Mm-hmm.
If you're advising a vendor, the seller, and they come to you, they haven't got an expert on their side yet. It's been a directly negotiated deal, and they come to you and say, I've got this cracking deal, the buyer's going to invest this much money, I can't take any of that cash off the table, it all has to stay in the business, and they're asking for pref equity. Are you saying, sounds like a good deal?
Well, we try not to get too involved in telling them about their commercials. We just document things most of the time. But I guess my question there is, well, what happens if you outperform? You know, so pref equity is very much about, you know, protecting the investor from underperformance. What happens if you outperform? So do you get to keep that, or do you share in that? So I think that's, you know, that's a critical question that people don't often ask.
Which then comes back, I was hoping he was going to say that they outperform. What's the dividend policy at Navisom? We've got pref equity, so if things go sideways, we get our money out first. But if things go over and above, do founders get dividend preferences over yourselves? Do you want dividends? Do you reinvest? What's your...
Yeah, so it depends on the business, but generally we like to invest in growth businesses. We want to find those where they can reinvest the profits. But certainly I agree with that. Like if we're going to give ourselves downside protection in almost every situation, we're giving upside, you know, much higher returns to the founder than we receive in a situation.
Double sides to the ledger.
Yeah, so if the business does really well, founder might receive somewhere between 2 and 3 times more on a percentage basis than we would. And that's how it should be. If you're going to take some downside, if you're going to give us some downside protection, then we should give you the upside.
And how does the bank feel about when they see these sort of structures?
Sorry, from a
amortization of your debt, and then there's a preference holder in there, in the sense that if things go sideways, that can sometimes...
Do we get paid first?
Yeah.
Again, it depends on the deal itself. I was about to say, actually, you know, there's plenty of transactions in certain industries we've looked at recently where we sit interest only because we're happy with the improvement of value in the overall business or the assets or whatever it is, and we're happy with that sustainable level of debt, and we know that there's going to be some money going out elsewhere. So look, it really depends, but it's not a hard no or a hard yes.
Okay.
Yeah.
Question time. I know there's a couple of questions coming in, but I do know there was one question from the floor, and I was talking to Michael Jones earlier on today, and he did have a question for us. Michael, we do have time if you'd like to throw that one at the panel.
Oh, well, that question is more, you know, we're in the middle of or the beginning of the 4th or 5th Industrial Revolution. I'm not too sure what number it is. And how does that, how can private business owners start thinking about that to their benefit when they're thinking about the exit of their ownership of the business? I'm talking about artificial intelligence and the sort of the next level of technical revolution.
Yep.
Yeah, and just exactly, because I think we were talking about this a while ago. What is AI? How does it improve? You were touching on, you know, elements of the medical, you know, sector.
Yep.
But, you know, do we, maybe to you, Will, in the first instance,
Sure.
do you see a particular sector or industry that can get sort of almost immediate uplift?
Yeah.
And to what degree?
Yeah, so I'll give you a specific example. So one of our businesses, they've got an outbound sales function. And that outbound sales function is staffed partly by some university students. And as is often the case, the young are the first ones to pick up these new technologies. So we had some of the uni students working in this business come to the management team and say, hey, we found some really great applications for AI in the way that we reach customers. And what they'd figured out was that they could use effectively ChatGPT to scrape the internet for all of these companies that they should contact. Then it could write them automated marketing emails that looked customized. Then they could send the emails and do all of this without really any human interaction. And so they were able to very, very quickly change the way that the top part of our marketing funnel works for that business. And this is university students who, you know, have no technical training or background or anything. So I think what's really cool about it is it's actually not that hard. There are some great advisors out there who are figuring this stuff out. And no matter what your business is, like, just get in touch and see if people can come up with something. Because my experience of AI so far and you know, generative AI has been you can start really small. It doesn't have to be like this massive project which is going to change your business. in really significant ways. It can be something really small that just makes things a little bit more efficient. I think that's one of the most exciting things about it.
It's cool.
At the risk of getting a question from the audience that Simon's not going to be able to answer, is there anything, any questions that anybody would like to pose to the panel from the floor? Glenn?
Yeah, definitely. And it happens across all different types of private equity funds. So the small funds, they will partner up with small family offices all the way up to big funds going and getting co-investment. That's what we call it in the industry. They'll get co-investment from super funds. And fundamentally what it's about is lower fees for your investors. So we earn our normal fee on our own funds, and we earn a much reduced fee on people who come in alongside us. So I would say for any people in the room who want to invest in private equity deals, you can put a little bit into the fund, and then you can say, I want co-investment as well. It's a good way of bringing your fees down. But don't tell anyone outside this room.
It's on video. Yeah. We'll edit
Made
it out.
a mistake.
Do we have any other questions from the floor? I'm not sure whether we might need to take that microphone to the next question, if we can, Amanda.
Sure.
Sorry about that, Glenn. We knew the answer to your question, we just couldn't hear the question. Sorry.
Anyone got a question? Roger.
Thanks.
Well, for
Yep, good.
well, firstly a comment and then a question. The comment I'd make is following on from the statement that was made that this tsunami of baby boomers selling businesses hasn't occurred, which I'm sure is quite right. My experience in both selling and buying businesses has been that one of the reasons that's behind that is the almost tautological statement that people are comfortable with investing in businesses they know. And so owners of businesses who are about to sell inevitably come up to the question, well, I'm going to sell this for X million dollars. What am I going to do with that money? And they look at the options and they think, I really don't understand those other investment opportunities. I'm better to stick with what I've got, even if I bring in a manager or whatever. So I think there's a significant element of why that hasn't occurred from that factor.
Yep, very true.
The question I had was, I'd be interested in an update on how you're seeing the mix of buyers changing over recent years, if you categorise them as listed corporates versus unlisted private companies versus private equity players, as the three groupings. How's that mix changed in recent times?
Why everyone looking at me?
I thought you wanted to answer
I do
that.
have, yeah, so there's a few.
Why don't you go first?
I'll go first. So I think what's important to address, Roger, in that is, has the nature of each of those buyers changed over the last 10 years? And in Australia, the private equity landscape has changed significantly. The size of the average fund in the small space, those funds, I would say we're going to get the data on this, but I would say it's probably 5 times as many small PE funds than ever before in Australia.
There's a lot more.
There's tons more, but we might get the exact data and publish that at one point. The larger funds, and we're talking about the Navises of the world, the Quadrants of the world, those, Pacific Equity Partners, KKR, those are big funds. Those funds traditionally have been getting good returns and they're writing bigger checks. And from a number of deals or deal volume perspective, the bigger check you write, the less deals there are. So the amount of funds out in the market continues to grow, but the number of deals private equity are doing on that basis at the large end of town is actually getting less and less. They're not doing as many deals. The small funds have a lot of money that's not committed, although it's committed in some sort of promise It's not in a bank account, it's not under management, it's not burning a hole in anyone's pocket. And as active as they are, and I'm only speaking from our experience here, we're not seeing cheques be written as much as we would think given their level of activity. Strategic buyers, that number stays very constant through any industry that you look at. It goes up and down through cycles. Childcare is a great example. There was no deals for the last 2 or 3 years. There's now about to be a ton of deals. And so that number keeps on keeping on. ASX listed companies, I can't remember the last time there was a massive ASX listed takeover deal or something of note that really got the headlines, do you?
Yeah, I would say your first comment I completely agree with. Like, private equity is proliferating. There are a lot more funds, and they're covering all ends of the market, and some of them are sector specific, and some are generalist, and there's a lot more of them around. So I'd say the level of private equity activity is definitely increasing, and you see that in the amount of dry powder that's in the market. I think
dry powder meaning cash not spent.
Cash not spent, exactly. I think we're seeing a lot more interest from overseas trade buyers. I think a part of that is because we're getting better at marketing ourselves. Australia's becoming a more relevant jurisdiction across lots of different industries, and so we're seeing more overseas trade interest. On the ASX listed, I think it's very industry specific. So there are some companies which remain very active serial acquirers, but it's just dependent on the company and on the industry.
Hopefully that gives you a bit of a response.
It was a bit of a politician's answer, wasn't it, Roger? Maybe we'll talk about it over a champagne and tell you what we really think.
Excellent. I think we'll wrap up shortly because I think we're sort of getting a little bit pushed for time. But I guess there's a couple of closing sort of summaries and remarks which I'm hoping to draw out of everybody. Some takeaways for people. We've touched on preparation. We've touched on being ready. Simon, you probably haven't spoken as much about not rushing and making sure that the deal's right for you.
The worst time to get ready for a deal is when a buyer knocks on your door. You should have already been ready. So I think my biggest advice is that it should be a proactive, even if it's not the priority of the business, it should be a proactive step on an ongoing basis, to Will's point, around an 18-month timeline in advance, so that when you do get a knock on the door, first you know if you answer it, because not every knock on the door needs to be answered. In fact, often go away, I'm not interested, will yield a much better response anyway, so do it anyway. And we certainly would play that game. No, we're not interested, but what have you got? No, it's not enough, go away, right? But second is when you do decide to let someone through the door and say, all right, let's see the colour of your money, absolutely slam them with how ready you are, so that there's a perception of you and 5 others are knocking at my door, you're not that important for me until you show me the colour of your money, and you have your house in order, and you're dealing with it in a courteous and respectful, but a very firm way. That's my advice.
Will, any closing remarks?
Yeah, I think from a private equity perspective, anyone out there who is thinking about a transaction with PE, there's lots of different funds. Private equity is not a single kind of monolithic industry where everyone's the same. There's lots of different personalities and ways of operating, and I think do your research and be well advised, and then you'll find the right partner. If you don't do that, to come back to our point around preparation, you might find yourself just speaking to the wrong people. So we're right for some deals, but we're not right for others. But there's usually someone else out there who is.
And Victoria, something from the
the only other thing to add yet, again around preparedness, don't be pressured to buy or sell just because the opportunity's there, and for goodness sake, have agreement within your own organisation and amongst your partners about what you're going to do and where you're going to head, because that's a good place to start as well, because if anyone catches on to that friction,
they'll take advantage.
We've all seen it happen, right? Yeah, they absolutely do. So, but yeah, I think with the as we said before, deals are taking a long time at the moment anyway, but I think some of that is around too, apart from the regulations that are coming in, from some of the changes I've seen in recent years, buyers and sellers are becoming a little bit more educated and a bit more savvy, and becoming a little bit more prepared, not all the time, but a lot of the time, and making sure they've got the right people and advice around them. Whereas I don't know whether that's fair or not, but yeah, I sort of feel like it used to be a little bit more
Disjointed.
Yeah, a bit more scattergun.
Justin?
Well, it's a constant theme, isn't it? Preparation. Preparation is equals value. So make sure you're ready.
Excellent. Well, I think we're pretty much done. So terrific. Really enjoyed it. Good conversation.
Very
Amanda, I might let
engaging,
you
very
close.
relevant. It was excellent. Thank you so much. So, obviously, first and foremost, we'd like to thank the panellists for today. We appreciate you taking the time and sharing your insights with us. So, thank you so much. And then thank you to our audience, so both online and in person. So for those that have joined us online, in the coming week you can expect a link to the recording and a summary of the questions that we perhaps didn't get to today. Appreciate we wanted to try and stick to a time. I know there's those that are online that will have other commitments as those in the room, so we'll come back to you with those at a later date. So thank you so much. We'll leave you here and we wish you a good evening. Thank you.
Excellent. Thank you.